Welcome to GRE. I'm your host, Keith Weinhold. Do you have any idea what banks do with your money, how home equity is like a bank, hot millennial rental trends, and then the proliferation of build-to-rent real estate today on Get Rich Education. Taxes are your biggest expense. The best way to reduce your burden is real estate. Increase your income with amazing returns and reduce your taxable income with real estate write-offs. As an employee with a high salary, you're devastated by taxes. Lighten your tax burden with real estate incentives. You can offset your income from a W-2 job and from capital gains. Freedom Family Investments is the experienced partner you've been looking for. The Real Estate Insider Fund is that vehicle. This fund invests in real estate projects that make an impact, and you can join with as little as $50,000. Insiders get preferred returns of 10 to 12%. This means you get paid first. Insiders enjoy cash flow on a quarterly basis, and the tax benefits are life-changing. Join the Freedom Family and become a real estate insider. Start on your path to financial freedom through passive income. Text FAMILY to 66866. This is not a solicitation and is for accredited investors only. Please text FAMILY to 66866 for complete details.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Glens Falls, New York to Klamath Falls, Oregon, and across 188 nations worldwide, the voice of real estate investing since 2014. You're listening to Get Rich Education. I'm your host, Keith Weinhold. You did not wake up to be mediocre today, so we don't focus on long-term budgeting here. Correlating financial betterment chiefly with reducing your expenses, that is just a race to the bottom. You and your peers would just be racing to the bottom and reducing your quality of life when you don't need to. We know that instead, yes, arbitrage is created when you borrow low and invest high, but the ultimate arbitrage, which is that gap or that spread, is when your quality of life vastly exceeds your cost of living. That right there, that's that gap right there that you and I pry open ever wider together right here every week. Savers lose wealth, stock investors maintain wealth, and real estate investors build wealth. Savers lose wealth because inflation makes holding onto a dollar like a block of ice melting away in your hand. Retail stock investors only maintain wealth because their 9 to 10% long-term return is worn down to less than nothing with inflation, emotion, taxes, fees, and volatility. And real estate investors build real, durable wealth. And, if you have a mentality of trading time for dollars and thinking that's the way, well, then you have a certain way of looking at your life. If you realize that your investing mission in your life is to build things that pay you to own them, then you truly have a different way of looking at life. And the resources that you need to build those things, that's what we cultivate here on this show. And you know something though, I gotta tell you, by the time that I bought my first rental property, I didn't have all of that figured out right there. It really wasn't until I bought my second property. It was also a fourplex, just like the first one. The second one cost $530,000. But check out how I bought it. I bought it with a 10% down payment, interest-only loan, and an interest rate of 7 5/8. Yep, I took accumulated equity from my first fourplex and used it as a down payment on the second fourplex. So that way, I essentially had zero money in the deal, in that second property, and that is that infinite return strategy, and both fourplexes cash flowed. Now, the interest-only loan on my second fourplex there, that gives some people pause. Why would I do that? Well, that kept my monthly payment amount down since I could only pay the interest portion and I didn't have to pay principal. Well, that turned a property with a small cash flow into a nice cash flow. But yeah, some people, old school, debt-free people, they don't like interest onlys because then the tenant isn't paying down your principal for you. Well, I typically want interest-only loans because for every dollar that wouldn't go into illiquid principal as equity, instead, that becomes a dollar of liquid cash flow that goes into your pocket. That's a higher use dollar than an equity dollar. In fact, the chances are is that the reason that you have fat equity in your home or your rental properties right now, that came from market appreciation, not principal paydown. In fact, why don't I do this? Why don't I approach the classic GRE principle of your return from home equity is always zero? And I'm going to do that from a new and novel angle here today. I mean, gosh, this could make you hundreds of thousands or millions over your investor career. Just imagine a bank. We'll call it a red bank, just so that you can visualize it. This bank, what it's offering you is zero rate of return. It's difficult for you to withdraw your money from this red bank. And in fact, they might not even let you withdraw your own money at all. It is at this red bank's discretion. Oh my gosh, how motivated are you to hold your money at that bank? Well, you are not at all. Well, what I just described there was equity that's locked inside properties, and that is exactly why your properties make terrible banks, so don't treat it like one. Equity is the opposite of you being liquid, and instead, the GRE way is leverage and arbitrage, but importantly, it does need to be supported by cash flow. So I would say, what do you think? We are not quite on an island here with our strategy, but we are still connected somewhat with the mainstream finance world. We are, say, on a peninsula then. I'm always talking about geography somehow, being this geography guy here. And like a peninsula, maybe real estate keeps you insulated, although not completely disconnected from that more volatile stock and bond shuffle that most people are on, which provides you with little to zero leverage and little to zero cash flow. And do you know what that stock and bond shuffle is, that seesaw? Let's remind ourselves that when money flees the stock market, it usually ends up in bonds. And as demand for bonds goes up, interest rates go down. So then as those interest rates go down, investors go back to stocks in pursuit of yield, and everything just reversed. So it's an ebb and flow of funds, which often provides you with zero real return. That's how that seesaw goes. So rather than getting a part-time job, which is selling more of your time, your finite time being sold for dollars, get a few rental properties instead of a part-time job. Whether you manage the properties yourself or you manage the manager, and by the way, that's what I do, I manage managers, well, you've got the income stream of a part-time job with an asset that appreciates at the same time. And as time passes, the reason that you will feel satisfied is because you took strategic risk and you didn't run with the herd like everyone else. Now, to stick to the bank analogy theme here, a lot of people, they still don't realize that when you take your money to the bank, you are a creditor of the bank, and the bank is now lending your money out. So just think about what you're doing. Well, you yourself, you're probably not doing so much of this. You're probably a better than average investor since you're listening here. But think about those depositors that keep a lot of money at the bank. Yes, we already know that you're losing to inflation, so we're not going to have that discussion here. But besides that, just think about what happens to your money this way. All right, what about a parking garage and your car? Okay, when you park your car at a valet, the valet is supposed to turn around and go park it in the garage. The valet does not have a right to take your car and let an Uber driver go make money with it while you're off having dinner. And then maybe they'll give you the same make and model back at the end of the night. Maybe they won't. and they stick you with the risk of having a problem with your car or with your money in this banking analogy. Well, that's what banks are doing with your money when you park it there. It's like a valet letting an Uber driver use it and take risks with it without your knowledge. What isn't FDIC insured is at risk. Well, what's the alternative to banks lending out the money that you deposited with them? All right, well, the alternative to the existing system that is dominant is that banks, instead, they could make money off fees that they charge to you. Well, how is it that you avoid paying fees to your bank right now like you are? I mean, after all, banks have all kinds of expenses, capital expenses, technology expenses. They have employee expenses. If banks charge fees to you rather than profiting from the spread that they get on lending your money out, well, then we could probably have a safer system. But most people, they like the allure of fee-free banking, partly because that's simply what they are used to. And banks used to have to hold on to $1 for every $10 that they had in deposits. That's also known as a 10-to-1 fractional reserve ratio. So they could go make gambling and bet with $10 for every $1 that they had to hold on to. Well, the risk of parking your money at a bank went up in March of 2020 because that is when the Fed just completely eliminated reserve ratios for banks. So now for every $10 that a bank has in deposits, banks can hold exactly $0 in reserve. Yeah, that changed a few years ago. So instead of parking your money at a bank, you do the opposite. You borrow from the bank, pay them their, say, 7% mortgage interest, and invest it in real estate pays 5 ways type of property that beats that 7%. And aha, yeah, there is your arbitrage. Now you're using their money instead of them using your money, like the valet that you entrusted with your car when you lent them your car and they gave it to the Uber driver while you were off at dinner. So outside of inflation, why is it risky to keep your money parked at a bank rather than borrowing from them? Because, as has often happened this year, banks implode. And why are they imploding? Well, just a couple years ago, banks lent on mortgages, say, at 3%. Well, then banks are only collecting 3% for 30 years. Okay, this is an oversimplified example, but follow along. All right, well, then what happens to the bank when interest rates go up? Well, no one wants to buy their 3% debt because the depositor, that's you, the customer, you want your money back because you can go invest it for 5% elsewhere. Well, that is a problem for the bank. And if the government does come in to give a bailout of your bank, well, we know by now that they're more likely to do that if it's a large bank like Chase, Wells Fargo, or B of A. Well, more government bailouts of banks means more money printing, which means more inflation, making our eventual problems even worse. So rather than keeping too much money at the bank, beat the bank. Now, earlier I mentioned how having a glut of equity in your properties is like keeping your money in a rather illiquid type of bank. All right, that is a germane point, a pertinent discussion to have right now, because think about this. This is America's equity position right now, right? This is for the latest quarter ended, the Federal Reserve Flow of Funds report. It tells us that U.S. households owned $41 trillion in owner-occupied real estate. All right, $41 trillion. That's the value of that U.S. residential property, all of it. And of that $41 trillion, how much of that do you think is in debt? And how much do you think Americans have of that $41 trillion in equity? And I'm just doing some rounding here. It is $12 trillion in debt, and the remaining $29 trillion is in equity. Yes, so therefore the national loan-to-value ratio right now is about 30%. That is historically quite low. And then on the flip side, therefore, what is quite high is another way to say it. America's primary residences have a 70% equity position today. Yes, 70% of the value of American homes is locked into that vehicle that is famously unsafe, illiquid, and always has a rate of return of zero there from home equity. Homeowners today, their average equity in their homes is $302,000. Now, as inefficient as that might sound from an opportunity cost perspective for those homeowners, there is at least a little upside to, let's call it your neighbors. Let's say we're talking about your neighbors that have this glut of equity, even if you're trying to opportunistically hold a low equity position. Well, this equity from your neighbors, that provides a cushion to withstand potential price declines and also prevents any future housing distress from turning into a foreclosure situation. So those equity cushions from around American neighborhoods, that's what helps prevent that down drain in prices that we saw from 2007 to 2009. I've got more for you coming up shortly, including has the build-to-rent concept that we've discussed on this show for years and years, has it finally gone mainstream now that NBC News is discussing it? You'll hear that audio clip and get my commentary on it shortly. But first, I want to ask you, is this like the golden age of quality newsletters or what? Now, news websites, they just seem to be increasingly riddled with paywalls, and they have logins and banner ads, and then you get a pop-up about cookies as soon as you land on the site, and maybe even the hassle of two-factor authentication. Instead, a quality newsletter, it's just automatically right there in your inbox. And our valuable Don't Quit Your Daydream newsletter, that is full of real estate investing industry trends and forecasts and broader economic forces that are going to affect you in the future and more. That's where you can get top investment property news friction-free. It's a read of under 5 minutes. You can sign up and get the letter free now at getricheducation.com/letter. And in there, recently, we've had it where you get updates about what provider has inventory now, even exact physical street addresses of properties. In fact, I've featured 2 of my very own rental properties in the newsletter as I broke down their financials. And again, you can sign up free at getricheducation.com/letter. Yes, I still write every single word of that letter myself. I don't think very many founders do that. And upon sign up, you'll receive a few lay of the land emails. And thereafter, I only send it about weekly, not daily. Alternatively, you can easily sign up for the letter by text. And if you aren't yet one of the many subscribers expanding your means with my letter, you can simply text GRE to 66866 for our Don't Quit Your Daydream letter. It is free. Again, you can sign up through text by texting GRE to 66866. More next. I'm Keith Weinhold. You're listening to Get Rich Education. With JWB Real Estate Capital, Jacksonville real estate has outperformed the stock market by 44% over the last 20 years. It's proven to be a more stable asset, especially during recessions. Their vertically integrated strategy has led to 79% more home price appreciation compared to the average Jacksonville investor since 2013. JWB is ready to help your money, and to make it easy for everyday investors. Get started at jwbrealestate.com/GRE. That's jwbrealestate.com/GRE. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
What's up, everyone? This is HGTV's Tarek El Moussa. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back. You're listening to episode 455 of Get Rich Education. I'm your host, Keith Weinhold. 5 weeks ago on the show, you'll remember that I reiterated why real estate does not pay 4 ways and does not pay 6 ways. It pays exactly 5 ways simultaneously, sometimes amid uncertainty. And note that there is just always uncertainty. Uncertainty never abates. People wondered when the Fed would stop hiking rates at a meeting. Well, now they did. People wondered when inflation would get back down to 4%. Well, now it has. But those that worry excessively will still point to something else that's uncertain. But in good times, bad times, and those uncertain investing times, you might want to get more offensive. And other times in your investment life, you want to get more defensive. Well, real estate does both because of the 5 ways you're paid. Appreciation and cash flow serve your offensive side. And then at the same time, kind of these quieter things going on in the background. You have your return on amortization, tax benefits, and inflation profiting. They all serve your defensive investor side. And now let's go look at the sources, the headwaters, the genesis. What are your 5 actual profit sources? Okay, for appreciation, it comes from the market. It's the vibrancy and diversity of the economic market that you have bought in. That's where your appreciation emanates from. The second way you're paid cash flow, that's your tenant and your tenant's job. That's where that profit source comes from for you. For the third way, your return on amortization, that ROA, that also comes from your tenant because that pays your loans, principal, and interest. The fourth way, tax benefits, that comes from the government. And then the fifth way, your inflation profiting, that also comes from the government. Yes, the government, they are like that factory creating and producing inflation perpetually. So that's the source, the headwaters for each of the 5 ways you're paid. And knowing that and thinking that through, that can help you be mindful about what to pay attention to in your investment real estate portfolio long term. And yes, all this is just with carefully bought, buy and hold real estate. And unlike most investments, if the value of your property goes down, you're still going to get paid 4 ways. So to review the 5 ways real estate pays sources where your money actually originates, it is appreciation comes from the market, cash flow comes from the tenant, your ROA comes from the tenant, tax benefits come from the government, and inflation profiting also comes from the government. Now, here at GRE, when we focus on your tenant and where your tenant comes from, one word that comes up an awful lot, and is probably going to continue to come up, is that word millennials. Why do we discuss millennials so regularly? Well, it's not because we're the first generation to embrace avocados or online dating over in real life dating, or being the first generation to be raised in a world of participation trophies. It's because not only are millennials the largest generation in American history, but they're in their prime household formation years. And although there is still some dissension among demographers, a lot of people agree, really the consensus is that millennials were born between 1981 and 1996. Okay, so that makes them age 27 to 42. They are prime household formation years. Yes, people are forming households later for the first time. And by the way, you probably know of the generation after that. You probably know that they are Gen Z. They were born between 1997 and 2012. So that makes Gen Z age 11 to 26. But do you know about the generation after that? Do you know what they're called? That is Generation Alpha. They were born between 2012 and today, making Generation Alpha age 0 to 11. Well, the millennial homeownership rate it lags behind that of previous generations of people that were the same age. So this is why you have such a deep pool of people that is driving demand for your rentals. Millennials have the misfortune of being stung by back-to-back global crises. They were coming of age in 2008, and then many couldn't get a job during the global financial crisis, and then the pandemic disruption made their independence pretty bumpy. In fact, fully 18% of millennials say that they plan to rent forever. Forever. That is up from 11% just 5 years ago. Not just a few, but the majority of millennial renters have zero down payment for house savings. Yes, 63% of them have absolutely nothing saved for a house. So this is why tenants are staying in places longer. And in fact, on top of that 63% that have nothing saved, another 14% have less than $5,000 saved, which is close to nothing. So that's a total of 77% of millennial renters that have essentially nothing formed for a down payment. And all that is according to a survey from Apartment List. More millennials plan to rent forever. Now, I've done a fair bit of research on Generation Z real estate trends. Again, they're the age between 11 and 26. And actually, there are a few more Gen Z homeowners than you might think already. But the short story of Gen Z, it just isn't that compelling. To distill everything that I've researched, most Gen Zers, they want to own a home, but they cannot afford it. Well, no kidding. That's not a very novel takeaway, but that's the real story distilled down there. If millennials then are oftentimes your current renters, then Gen Z are your current and future renters. Now, I've talked to you a good bit about the interest rate lock-in effect for quite a while. It's that effect where so many homeowners have ultra-low mortgage rates, so that means they don't want to sell their home, and then when they don't put their home on the market, that further constrains the available supply. Well, Redfin recently brought some new color to the interest rate lock-in effect. They shared some really interesting material with us. 92% of mortgage borrowers have an interest rate under 6%. 80% of them have an interest rate below 5%. Among those that have an interest rate below 4%, that is 62% of mortgage borrowers. And for those with a rate below 3%, a quarter of people have a rate that low. And new listings of homes for sale and the total number of listings, they have both dropped to their lowest level on record for this time of year. And that is fueling homebuyer competition in some markets, and that's what's preventing home prices from falling. In fact, Redfin tells us that the national asking price for homes, it's exactly the same that it was 1 year ago. And sales prices increased the most in these 5 metros. This is the latest from Redfin. Cincinnati is leading the way at 9%, and we've got cash flowing Cincinnati property at GRE Marketplace. In second place is Miami at 8% annual appreciation, not really a cash flow market there. Third best is Milwaukee at 8%, rounded out by Fort Lauderdale, Florida at 6%, and Virginia Beach, Virginia at 5%. They are the 5 metros with the highest appreciation. Current months of national housing supply is still just 2.6 months. That is some scarce inventory. Of course, 6 months is a balanced market. And really just one last interesting stat from Redfin is that homes that sold were on the market for a median of 28 days. That is the shortest period of time since September, okay? And there is a bit of a seasonal factor there that you need to consider in that one as well. Now, we talk about the paltry supply of homes since existing homeowners don't want to sell and lose their low rate. That has forced more home builders to build. That's how you make more housing supply available. It's made a good opportunity for you to buy these homes that are built for renters from day one and then rent it to a tenant yourself. Now, I know that your life is more interesting than watching the NBC nightly news with Lester Holt and then dozing off to sleep at 9:30 p.m. So, in case you didn't catch it, here it is on Build to Rent last week. And this really takes the perspective of the renter and why they want to pay you rent to stay in a build to rent home longer than they do for an apartment. This is about 2 minutes long, and I'll be back to comment.
Still to come here tonight, the rush to rent, why more people are saying yes to signing a lease, and how it's shaking the foundation of housing in America. Trying to buy a home these days is a real struggle between high mortgage rates and low inventory. Many are finding themselves priced out. But as CNBC's Diana Olick explains, it's fueling a boom in so-called build-to-rent properties.
Single mom Robin Ashford had planned to buy a home near Columbia, South Carolina last year, but mortgage rates suddenly shot sharply higher.
I found out that I wasn't going to have as much buying power as I would have about 2 or 3 years ago. And my monthly mortgage payments were too much that I could handle.
So instead, Ashford turned to this brand new community built specifically for renters.
I don't have to worry about taxes on the home. I don't have to worry about if something breaks. It's the landlord's responsibility.
They have large open floor plans.
And an increasing share of the landlords are now big builders, like Bruce McNeelage's Nashville-based Kinlock Partners, as more Americans decide to rent not only by necessity, but by choice.
We've had a societal shift to people wanting to rent because they want a maintenance-free lifestyle, or they want the ability to move to a city and just give the keys back to the landlord at the end of the lease.
Builders put up 68,000 new single-family rental homes last year, a 31% increase over the year before, according to John Burns' research.
I think it's at the early stages of being a very, very big business, just like the apartment market is.
Burns counted 708 build-to-rent communities coming soon across the U.S., entire communities of single-family homes built not for sale, but specifically for rent.
The people that want a home but have now been priced out due to rising prices and then rising mortgage rates are saying, well, I want a home, I'm going to rent for a while. So it's created more demand for the rental homes.
And renters are demanding more of the builders, amenities like pools, fitness centers, dog parks, of course on-site maintenance, and as in this community, bigger backyards. But all that comes at a price. The average rent here is about $2,200 a month, and single-family rents across the nation are rising.
That's something that I do need to think about, because trying to save for a home while paying high rent, it's hard.
For now, she's enjoying the new home, even if it's not her new home. For NBC News, Diana Olick, Blythewood, South Carolina.
Yeah, that's the popularity of build-to-rent homes, something that we've been discussing here at GRE for maybe 8 years now. Like they said, their rents are on the rise, but they're not rising nearly as fast as they were a year or two ago. Rent growth has slowed for both single-family homes and apartments. I think that the assurance for prospective income property owners like you is that in your build-to-rent properties, you can have a reasonable expectation of high occupancy and low vacancy as long as you buy your single-family rentals in a decent market. Who knows what rent growth is going to do over the long term? But those are some things that you can count on with really good occupancy and demand. And see, more often than not, a builder, they're only going to build something like new rental single-family homes if there are plentiful jobs and growth nearby in order to support that. So what you can kind of do is crowdsource the due diligence that the builder did on what is demographically and economically feasible if you are choosing to add these property types to your portfolio. And despite the build-to-rent properties added today, America still has only half as many homes available as they did in 2019. And in 2019, there weren't enough available. So there's only half of that. And then compared to just a year ago, there are 5% fewer properties available today. But we do have available build-to-rent and existing income property here at GRE Marketplace, both types, new build and existing. And yeah, just create one login, one time, and get access to all national providers at gremarketplace.com. But now, say you don't want to be as independent and you want a little help, a little coaching. Perhaps you have not bought a property before at all, or you haven't bought one in a while, or you haven't bought property across state lines yet, since that's where the best deals usually are, or you just want to lean on a coach to bounce ideas off of. as you are looking for your next investment property as you look across the nation? Well, in that case, you can rely on our free coaching service. That is at gremarketplace.com/coach. And our coaches don't blow the whistle at you for missing a play, okay? You're never going to find them as grumpy as, say, New England Patriots coach Bill Belichick, okay? They're not that kind of coach. They're not the kind of coach that will ask you to start your morning at 4:30 a.m. with an ice bath. And if you are new to real estate, there's just no such thing as a bad question. There's no such thing as a stupid question with GRE investment coaches. They don't throw any penalty flags at you. So to find that property that builds your residual income and pays you 5 ways, you can choose which coach you want to have help you over there on that page. Coaching, again, it is a completely free service for you. And what the coach does is they learn your goals. They find you the best off-market deals nationwide, and they'll find you the property provider with the incentives. One provider recently offered 4.75% interest rates, like I had talked about a while ago. Another offered free property management for 1 year. Your coach will help you write your offer if you would like that. They'll help you submit your earnest money, navigate the property inspection, interpret your appraisal, check your management agreement, and just ensure a smooth closing day for you. Your investment coach can do more than this, and if you prefer, they can do less than this for you. And GRE Marketplace is where the coaches source the properties, and it is more like an organic farmer's market than a big box store. Property offerings change frequently, and because there are limited slots available to talk with them through the phone or Zoom, it helps if you've got your down payment in line and you are ready to go. I mean, sheesh, if it were any easier, they would even make your down payment for you. And I think I mentioned that it's free. So to get started, choose your coach and book a time. Start at gremarketplace.com/coach. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.